It's Wednesday, September 28th. Thanks for joining us at xm.com for the Daily Market Comment by Mario Sajikiriakos. I'm Cristina Marujos. A sell-off in global bond markets has snowballed into a meltdown, sending shockwaves across every asset class. Central banks are still in a crusade to vanquish inflation, and governments are finding out the hard way that markets won't tolerate massive unfunded deficits when interest rates are so high, a combination that has generated tremendous volatility. Liquidity dried up completely this month as the Fed ramped up its bond sales through quantitative tightening, which has translated into a meteoric rise in borrowing costs. Yields on 10-year U.S. Treasuries breached the psychological 4% mark for the first time in a decade. With every asset getting crushed under the boot of rising rates, there has been nowhere to hide this year except the U.S. dollar. The greenback has obliterated everything in its path, riding the perfect wave of widening rate differentials and safe haven flows as the rest of the world grapples with even uglier crises. In the broader FX market, the spotlight remains fixed on the United Kingdom. The pound hit new record lows against the dollar this week, becoming the shining example of what happens when an economy's twin deficits widen uncontrollably through a trade shock and unfunded tax cuts, while rising interest rates exacerbate the debt burden. Market participants are effectively saying irresponsible tax reductions will add fuel to inflationary pressures, forcing the Bank of England to raise rates with reckless abandon, which in turn will amplify the severity of the recession that the central bank already expects. Therefore, even an emergency Bank of England rate increase might not be enough to turn the tide in sterling. Euro-dollar fell to fresh two-decade lows as Europe's energy crisis entered a new chapter following attacks on the main pipelines carrying gas from Russia, which are believed to have been acts of sabotage. Gold prices briefly sliced below the recent floor of $1,620 earlier today. This entire quarter has been a horror show for bullion, which has lost 10% of its value since July, crumbling under the weight of an appreciating U.S. dollar and real yields going through the roof. On Wall Street, the S&P 500 traded at its lowest level in nearly 2 years yesterday, although it managed to close above those lows. The breakneck increase in interest rates continues to compress valuation multiples, and there might be even more pain in store for equities because valuations are still not cheap enough. Thank you for watching today's Daily Market Comment here at xm.com.